Welcome to this explainer. Today we're diving into a massive financial mystery surrounding India's largest private sector bank. If you follow the markets, you know that right now literally everyone is talking about HDFC Bank. They just released their Q1 FY27 earnings, and honestly, it's left a lot of investors totally scratching their heads. We're going to break down exactly what's happening under the hood, using the data and the balance sheet to understand the real story here. So let's jump right in.
Just take a look at this number. In the first quarter of FY27, HDFC Bank reported a staggering standalone net profit of over 19,060 crore rupees. To put that into perspective, that's a 5% jump year over year. I mean, by any normal measure, generating nearly 20,000 crore in pure profit in a single quarter, that is an absolute flex of financial muscle.
So with record-breaking numbers like that, you'd totally expect the market to celebrate, right? You'd expect headlines praising their continued dominance. But nope. Instead, investors aggressively hit the sell button. And that is the core question we need to answer today. Why on earth would Wall Street and Dalal Street punish a bank for making a massive pile of money? The reaction wasn't just a tiny dip either. The stock plummeted more than 5% on earnings day alone. And if we zoom out a bit, HDFC Bank has actually shed a massive 21% of its total value this year, in 2026. It presents a fascinating paradox, really. To unravel it, we can't just stare at the headline profits. We have to look closely at the underlying engine of the bank.
Section 1. India's Banking Behemoth.
To truly understand why the market is punishing these profits, we first got to grasp their sheer scale. Tracing its roots back to a 1994 RBI approval, right in the wake of banking sector liberalization, this institution has spent exactly 3 decades aggressively compounding its growth. It started as a promising private sector player and evolved into a literal titan, culminating in a historic 2023 mega merger where HDFC Bank absorbed its parent company, HDFC Ltd.
And that 3-decade growth, it translates to total market dominance today. HDFC Bank is the undisputed heavyweight champion of the Indian stock market. It holds the absolute highest weightage in the Nifty 50 index at 11.15%. That's significantly higher than its fiercest rival, ICICI Bank, which sits at roughly 9%, and even higher than the massive conglomerate Reliance Industries. Honestly, when HDFC sneezes, the entire Indian market catches a cold.
As highlighted by this ICRA rating, this massive asset base cements its status as a systemically important pillar of the economy. In banking terms, that basically means it's literally too big to fail. They command over 14% of the entire banking sector's advances in India. So, when a bank this crucial shows even a hint of structural weakness, investors pay very, very close attention.
Section 2. The 2023 Mega Merger. Okay, so when HDFC Bank absorbed its parent company, it gained incredible scale, but it fundamentally altered its balance sheet. Think about it. A normal bank makes money by taking in low-cost deposits, like your everyday savings account, and lending that money out at a higher rate. But post-merger, HDFC Bank inherited a massive mortgage book bloated with expensive legacy debt from HDFC Ltd. These legacy borrowings cost significantly more than typical retail deposits. A recent academic study on this exact merger by RJPN summed it up perfectly. They noted that, according to adjustment cost theory, the true benefits of a merger like this only manifest after a certain period of time. The short-term reality is basically a painful integration hangover. The bank is essentially still digesting a multi-billion-dollar meal it ate 3 years ago.
Section 3. Decoding the margin squeeze.
Now, this integration hangover directly leads us to the core technical reason why investors are panicking right now. We have to talk about net interest margin, or NIM. NIM is the critical difference between the interest a bank earns on the loans it gives out and the interest it pays out on its deposits and borrowings. It's essentially the core engine of any bank's profitability. If your NIM is shrinking, well, your core business is getting less profitable, regardless of how huge your loan book gets.
So the crucial point is this number right here. 3.26%. HDFC's net interest margin just crashed to 3.26% in Q1 FY27. That's its lowest level on record, down from 3.38% just the previous quarter. Why? Because those high-cost legacy borrowings from the merger are basically eating into their profits. The cost of their funds has remained stubbornly flat, while the yield on their assets actually slipped a little bit. The severity of this really hits home when we compare it to their fiercest rival,
ICICI Bank posted a much cleaner, robust 15.9% profit growth this quarter, alongside an improving NIM of 4.36%. By comparison, HDFC's 5% growth looks pretty sluggish. And actually, to make matters worse, that 5% was inflated by a one-time gain from a stake sale in HDB Financial Services. Without that one-time boost, the core earnings picture would have looked even more stressed. Compounding the anxiety for investors, we have to look at their deposit quality. The CASA ratio, which stands for current account, savings account, and measures a bank's access to cheap deposits, shrank to just 32%. A declining CASA ratio signals to the market that HDFC's overall cost of funds isn't coming down anytime soon. They're basically having to rely on more expensive forms of funding just to keep the machine running.
Section 4. HDFC Bank SWOT Analysis.
Taking all this integration pain and margin pressure into account, where is this behemoth strong? And where exactly is it vulnerable? Let's start with their strengths. We have to acknowledge that their physical infrastructure is practically unmatched. They boast over 9,400 branches and more than 21,000 ATMs across India. They maintain incredibly high brand loyalty, constantly winning awards for their private banking services. Plus, they've managed to bring their employee attrition rate down to 22.6% in FY25, which shows an improving, stable workforce. The foundation? It's rock solid.
However, no giant is without weaknesses. Despite that massive branch network, they still struggle to capture the rural market effectively compared to some of their peers. On top of that, auxiliary products like wealth management and insurance haven't quite reached their full potential. Furthermore, a traditionally conservative marketing approach has perhaps limited their ability to aggressively capture newer, younger demographics, and that definitely contributes to the kind of stock price volatility we're seeing right now. On the bright side, though, the opportunities for a bank with this much capital are vast. The SME, or small and medium enterprise sector, offers massive corporate growth potential. Also, strategic collaborations with agile fintechs could drastically modernize their appeal and operational efficiency. There's also a growing runway for sustainable green loans, and with their massive NRI base, global expansion remains a highly lucrative, untapped frontier.
But to get there, they've got to navigate some serious, immediate threats. Most notably, the aggressive market share grabs from ICICI Bank, which is currently operating with way less structural baggage. They also face the looming disruption of digital-first, new-age competitor banks that are quickly winning over tech-savvy customers. And while their asset quality is currently stable, any rise in non-performing assets, basically bad loans, could severely dent their recovery. Which brings us to the ultimate question surrounding this explainer. With a 19,000 crore profit but painfully shrinking margins, I'll leave you with this to consider. Is Wall Street just being overly impatient with the growing pains of a necessary historic merger? Or has India's greatest compounding machine finally peaked, bogged down by the weight of its own ambition? Keep a close eye on their margins next quarter, because that will absolutely hold the answer.